Welcome once again to Casting Strategies. This time I have the honor of interviewing Jack Forehand. He's the co-founder and president of Validea Capital Management that was founded in 2005 and Validea.com that was founded in 2003. He's also the author of several research publications and academic articles. He's also the co-host of the podcast Excess Returns with Justin Carbonell.
Hi, Jack. How's it going? Everything okay there?
Yes, everything's going well. Thank you for having me.
Yeah, it's an honor for us. It's an honor. Now we are in this idea of interviewing American investors, and we are trying to bring us here to bring you here in Spain, and it's really fun actually. So we are learning a lot in our audience also. So it's an honor to have you on.
Thank you for having me.
It's an honor. Okay, so Jack, my first question is, what drove you towards the investment industry? That's the simple question. Yep.
Yeah, no, a lot of investors have a story, when they were very young, they got a paper route and they saved up a little bit of money and, they bought their first stock when they were young. And I'm totally the opposite of that. I had no interest in investing whatsoever until probably my senior year of college. And I just happened to be walking around one day. I was an economics major at the University of Connecticut. And I happened to be walking around one day and I saw a piece of paper on a wall, which was an advertisement for an internship. And the advertisement was from John Reese, who eventually became the founder of Validea. And John had sold his company. He was in the technology industry and he had sold his company and he was looking for a way to invest his money. And what he was doing at the time is he was trying to read magazines like, say, Forbes, or watch CNBC or read TheStreet.com. He was trying to use that as a way to figure out how to manage his money. And what he found is he couldn't figure out who to trust. And so what he was doing is he was hiring interns to try to go through all these magazines and to write summaries of all the stock recommendations within them, and then to try to hold the people in the magazines and the TV sources as well accountable for the recommendations. And so what we would do is we would read an article in Forbes. We would say, all right, they picked these 5 stocks. We would put that in a database. And then we would track the performance of those stocks for, say, a week or a month or 3 months or 6 months. And we were trying to figure out, which sources should you listen to and which sources should you not listen to. And so my first foray into investing was working with John on this project to try to summarize these recommendations. And that eventually, that was during the whole .com boom. And so just like a lot of companies in that time, that company had a very high valuation. It got a lot of venture capital. We grew it to 50 employees. And then when things fell apart in 2000, we quickly headed in the other direction. But what was left in the sort of the aftermath of that was we had a secondary product as well that we ran, which was called Guru Analysis. And that was not the primary focus at the time, but it was on the website. And the whole theory of Guru Analysis was trying to find quantitative, instead of trying to figure out, find people in Forbes we should be listening to, is to try to find quantitative strategies we should listen to. And so we went through, books about people like Warren Buffett or academic papers, and we tried to create quantitative models that people could follow. And so what happened is, in the aftermath of that company not working, we started what is now Validea, which was following these quantitative strategies. We eliminated the part about, following the magazines, and we followed the quantitative strategies that we had found had stood the test of time. And so it's sort of an indirect route, but that's how I ended up in investing.
Well, it's super interesting because you got started with the very same company you are working with now. So it's the long story there. No, it's pretty interesting. This, yes, for sure.
Yeah, actually, my entire career has been, I've done nothing but, there was a little period of time where I helped my uncle out with his business in between the 2 versions of Validea, but for my entire career, this is what I've done.
Oh, awesome. Okay, so this thing that you mentioned before is the Guru's quantitative models that you put there together. It's one of the things that I like the most out of your website. And but I have a question here that is, do you think people are able to stick with the strategies picked by themselves, or they take a winning system and use their judgment to unintentionally eliminate all the outperformance and then some? Do you think this is happening, or what's your take on this?
Yeah, no, I think, Validea is for self-directed investors. And so people use it in different ways. Some people may follow one or more of the models. Some people just use it to supplement their own system. But yeah, in general, you're absolutely right. these factor strategies are very, very difficult to stick with, particularly the types we run in Validea, because we run very focused factor strategies. I mean, if we're trying to follow someone like, say, Ben Graham, we're running a 10 stock version of that portfolio, and we're running a 20 stock version of that portfolio. And those are very, very focused strategies. And, one of the things I probably didn't know at the beginning, but I've definitely learned over time is, when an investor is 10% behind the market in a given year, or when an investor trails the market for 3 years or 5 years, or in the case of some of the value strategies, even 10 years right now, they're going to abandon that strategy for the most part. And so, yeah, no, I think your point is very well taken, which is it takes a certain type of investor to follow a focused strategy. Most investors are not able to, because when these strategies are struggling, you're going to hear things in the media like you hear with value right now, whereas this doesn't work anymore, or, this is never going to work again. And that's very hard for an investor to overcome and to continue following the strategy. So I think you're 100% right. These types of strategies are very hard to follow. And we highly recommend people, if they're going to follow our strategies, that they blend multiple types of factors together, and that they don't just try to follow, say, the deep value strategy, because that's very, very difficult to do.
Yeah, that's interesting. Sure. And why? Because in this case, I see it clear. You are a quant investor. I also love quant investing. So I understand your point. But why systematic over discretionary strategies, Jack, in general? I mean, in this case, I'm talking just in general. What would you say to the investors?
Yeah, well, for me specifically, it's sort of my evolution as an investor. I talked about when I sort of learned about investing when I was a senior in college. Another thing I was doing at the same time is I bought my first stock, and it was a tip from my uncle's broker, and it was a Canadian garbage company. And so I thought, this is great. I'm going to put a couple $1,000s in this. I'm going to make tons of money. And obviously it went the other way. I mean, the Canadian garbage company went bankrupt. I didn't even end up owning part of a garbage truck or anything. I basically had nothing. And so that was my introduction to investing, is I learned that as an investor myself, I may not be the best decision maker. And at the same time, we were also following these magazines, and I was also sort of learning about the mutual fund industry. And what I figured out is the recommendations in these magazines as a whole were not very good. Most of these recommendations were not doing any better for you than you could do by just buying an index fund. And most mutual fund managers were trailing an index fund. So I was learning about my own weaknesses as an investor. I was learning that my emotions get the best of me. I bought some more of that Canadian garbage company on the way down, which was a terrible decision. And so I was just learning that as humans, we're not really built to be great investors. And so that's sort of, for me personally, and I have nothing against discretionary management. I think there's some people that do a really good job with it. It's just, by and large, I think humans are not great investors. And so for me personally, I was better with more of a systematic or quantitative approach.
Yeah, totally. In my case, it happens something like that, totally like trying to cherry pick stocks is like, oh man, I can't do it anymore.
Yeah, it's very, very
systematic way. Okay. So in one of your articles, Jack, called "When Quantitative Becomes Discretionary," you mentioned that machine learning may eventually be the catalyzer to eliminate human decisions making from the process of investing. But for now, the purely quant model is more of a dream than a reality. Do you believe the pure quant model, totally automated by and powered by AI, would make the difference?
I think we're a long, long way from that. And, my point with that article was, people think when they invest in a factor strategy, they're investing in something that's purely quantitative. But the reality is, whether we're managing it or somebody else is, the reality is there's a lot of decisions that go into that model. You have to start from the beginning. What factor am I following? Am I following value? Am I following momentum? How am I representing that factor? Am I using the PE ratio or the price to book, or am I using a composite of factors? How many stocks am I holding? How often am I rebalancing? There's a lot of decisions, and it's very hard for a computer right now to make those decisions. And I think we're a long way from where a computer is going to do a better job of making those decisions than a person. One, because they're very challenging decisions. They require you taking a lot of information in, but two, because strategies in a lot of ways need to be built for specific people. And so we talked earlier about very focused quant strategies. For many investors, focused quant strategies are not appropriate because they're very hard to stick with. So for one investor, a focused quant strategy might be best, but for another investor, something that just reweights the S&P 500 based on factors might be better because it's going to be easier to stick with and it's not going to deviate as much. So I don't know. I think it's very hard for a computer to make all of those decisions. So I'm not an expert in machine learning, but I do think it's going to be a while before you don't need a good person behind a quant strategy making the decisions about how it's run.
Actually, we bought a company, an AI company in Austin, in the States, and we are trying. And this company does many things, different fields, but one of it it's investments. And actually, we are trying to to fathom the way to do that, and it's way complicated. You are totally right. It's in our case, it's we're trying to study the way to, to have the machine pick the different factors and the asset allocation, right? The construction portfolio, but it's way complicated. We're working on that, and maybe in a few years' time we will have something that is true that is way complicated. So far, I have to tell you that it's right.
One of the things, it's just there's so much that goes into that decision, and I think it's hard to do it right now unless you're a human, but also we all tend to underestimate technology. And so I don't want to take away from the fact that might actually work eventually, because I think what technology is doing right now, we probably didn't think it was going to be able to be done a decade ago. And so, totally. But it's more the decisions, we've talked about, we talk a lot in our podcast about the price to book. If I'm using something like the price to book in my strategy right now, and I have to make the decision, do I take it out? That's a hard thing, I think, for a computer to figure out right now, because you're balancing long-term data plus, various arguments as to the efficacy of the factor now. I think that's a very difficult thing for a computer to do right now, but maybe eventually that is something a computer can do.
Totally. I hope. Actually, I hope. Totally. Okay. So, in one of your recent podcasts, hosting Kai Wu, he delivers a justification for the death of value investing based on the rise of intangible assets. What's your take on the massive eruption of disruptive innovation in tech regarding the future of the value factor?
Well, I have two answers, and it's sort of, we just did a sort of a mashup episode where we put together everybody's best insights on value investing.
It was awesome.
Yeah, thank you very much. I would probably echo what Kai said in that episode, which is, I think there's sort of two answers here. There's the cyclical answer and there's the secular answer. So the cyclical answer is value is very, very cheap right now, even measured with standard metrics. It's as probably close to as cheap as it's ever been. And so I don't think now is necessarily the time to be reworking all of the traditional value factors, for the next decade, because I think those value factors, because they're too sigma cheap, likely, if history is any guide, are probably going to come back into favor and probably do okay. And so I don't know that, restructuring all of value right now to try to take into account intangible assets, where you end up buying companies that are more expensive on the standard metrics is the best thing to do from a sort of the most recent decade standpoint. But looking forward, I think he's 100% right. I mean, if you look at the U.S. economy, I don't know what it is abroad, but the U.S. economy is assets on companies' balance sheets are at least 50%, if not more, intangible right now. And so trying to measure companies, the value of companies, when more than 50% of their assets are not showing up anywhere on their balance sheets, is not a good way to invest, especially at the top end of the range, the Googles and the Facebooks of the world. Yeah. It works a little better at the bottom end of the range, just because those companies have a lot less intangible assets. If you look at like maybe a steel company or something that's very cheap, they have a lot less intangible assets. So their adjusted price to book would be very similar to their regular price to book. But trying to use at the top end of the range, trying to value a Google or a Facebook or an Amazon with price to book, I think he's completely right. I mean, I think that's a useless metric at this point.
Totally. No, I think it's something that I'm struggling with also, because this situation where the value factor per se is not working over the last years, 10 years almost, and it's complicated. And this episode that you mentioned before, it was awesome, because it's like, putting together many investors at a time, and they're answering why value should survive. I don't know. We'll see. What's your take on that exactly? So because in that case you were asking, and Justin also were asking the investors, but what's your take on that? Do you think value is dying or is dead?
Yeah, so I try to take a step back and look at why did value work in the first place. And, I did a little bit of the intro to the episode, which was probably the least intelligent thing said, was my part of it. But, I look at the two reasons, value works. And one is because it's riskier, and one is a behavioral reason. So I look at this decade period and I say, is there anything in this decade that would tell me value is less risky than it's been historically, whether that's from a volatility standpoint or whether that's because, from the perspective of having these extended periods of underperformance. And I don't see anything that says value is less risky. And then the other part of it is people tend to overestimate the problems with value related companies, at least as a whole. And so the stocks trade a little bit below where they should. And over time, the market realizes it's overestimated the problems, and you get this valuation adjustment that Wes Gray talked about in that, in that podcast, where the valuation moves up a little bit. And so the question is, do we feel like people aren't doing that anymore? The problems with value companies are actually worse than people think they are. They're not overestimating those problems. And so I think both of those reasons still hold. I don't see any reason to say anything has changed. And the other thing that gives me some solace in this is when you look back historically, there have been other periods like this. O'Shaughnessy Asset Management looked at a period from 1926 to 41 where there was technological change and you had a big period of struggle for value. We obviously had the late 90s. And in all those cases, value did come back. So for me, being able to see it in the past and see that we did recover from it gives me some, at least, solace that it's going to come back again.
Certainly. Okay, I think this episode actually that you mentioned, it's an episode that, I encourage our audience to listen to this episode because it's awesome. So I will put a link in our show for our audience to get this episode because it's really incredible. Okay, Jack, so thanks a lot. It's been a pleasure to have you on in this interview. It's been a few questions, but I think really interesting, the answers, and I hope our audience can enjoy this chat that we have had. And I don't know, we hope to have you on the show again next time. I don't know. We'll see.
I'll come back after value's back in favor, and we can we can congratulate ourselves for predicting it to come back into favor in the future.
That might be awesome. Totally. Okay, let's do it that way.
So thank you very much for tuning in. It's been a real pleasure interviewing Jack. I bumped into his website and his work on validea.com, and I think he's been a great person giving access to investors to a quantitative strategy. So I really hope you enjoyed this talk. If you like this, you can watch the masterclass on ZONAVALUE. Remember, if you liked it, give it a thumbs up and subscribe to our channel and share the interview. Thank you very much.